Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, cut your taxes, and have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. I have my trusted, esteemed co-host, Matt Nadeau here.
Hey, everybody.
And we're, of course, both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area. And we are fiduciaries. And as an independent, family-owned firm, we truly have the freedom to focus solely on your interests and not some corporations or those shady private equity companies that are buying everything up these days.
And of course, want to take a moment to say hi to all of our clients who are listening today. Hope you're having a wonderful day. And of course, we just want to stop and say thank you. We appreciate the trust you placed in us. And of course, we love every one of you. And we have a really good show planned for you today. Some very important topics that I think a lot of the general public out there, a lot of people out there may not know some of the differences in our industry on some very important things. And one of them that we're going to talk about in the first segment is active investing versus static investing. And most advisors and money managers out there, even when they say active, they don't do anything. They're just static. We're going to talk about what that means and how you can tell the difference. And then later in the show, we're going to talk about something that's really important in the industry when you're picking to work with a financial advisor is a fiduciary versus a non-fiduciary financial advisor. And like Ben was saying earlier, we are fiduciaries. We're going to tell you what it means, how you can tell the difference, and you don't want to miss that.
No doubt. But before we start, we encourage you to subscribe to our YouTube channel on moneyhourradio.com, where you can view this week's episode along with previous ones. Please also subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's informative, succinct, easy to read. You get a really good idea of what we're seeing that week, what we're analyzing. You can sign up for it at bnwealth.com. And while you are on BN Wealth, please follow us on our social media pages on Facebook and Instagram. All right, Matt, let's get into our first topic today.
Yeah, this is something that's near and dear to our hearts. So we want to talk about this classic showdown. It's like the old Westerns where the two gunslingers are walking up. And the first one is the chill, set it and forget it, buy and hold investor. That's the static investing. And you got the other side, the hyper alert, coffee fueled, tactical investor who refuses to go down with the ship. And investors broadly face a fundamental choice in portfolio construction. You can go out and adopt this static buy and hold approach that's really rooted in modern portfolio theory. And that's what most people do. Or you can pursue a more flexible and dynamic, actively managed tactical investment strategy, which is what we do.
And there's a joke about modern, right?
Well, you know what they say. I mean, I always tell people that modern portfolio theory was invented before the hula hoop back in 1952. So how modern can it be? But now listen, both approaches have some merit, and they do differ significantly in philosophy, execution. And I think what's most important is how they respond to market downturns.
No doubt. So a static buy and hold strategy grounded in market portfolio theory, modern portfolio theory, emphasizes diversification across asset classes to try and optimize the right balance between risk and return and safety. Portfolios are typically constructed using these long-term historical correlations and expected returns, and then periodically maybe rebalanced, basically set it and forget it for the most part.
I mean, Ben, like, what could go wrong with that? I guess we'll get back to that in a minute.
Now, buy and hold investors are basically, if you look at it, they're kind of in a long-term relationship with the market. They've accepted that sometimes things get rocky, maybe even abusive, but they're committed. Through the ups and downs and the occasional 50% portfolio drop that makes you question every life decision that you ever made. So basically, it's low maintenance, and historically, it works out eventually. And the key word there is eventually.
Yeah. And listen, that's because this approach has what we would consider its critical weakness. It largely accepts that market downturns are just unavoidable. Basically, there is no plan for them besides just hope. That's why we jokingly sometimes call it buy and hope. You hope the market doesn't go down too much. And if it does, you hope it doesn't take too long to recover. And unfortunately, hope by itself, that's not really a good strategy. So if we look back during major bear markets, 2000 through 2003, the dot-com crash, we can look at the 0809 financial crisis crash, even the COVID crash. These static portfolios are often experiencing catastrophic, significant drawdowns. And investors are effectively asked to endure these declines and just stay the course. Sometimes you end up waiting years to recover these losses. And this can be both, psychologically and financially challenging. And where it really gets difficult are for those nearing or in retirement or people who are relying on their portfolio for withdrawals and income. And when you're going through that crash, suddenly it's a lot less long-term discipline. And it's like, should I just sell everything and move into canned goods?
And in contrast, an actively managed tactical investment strategy, like our Advance and Protect portfolios that we manage for our clients, it seeks to adapt to changing market conditions. So rather than just maintaining fixed allocation, cookie cutter, tactical managers like us dynamically adjust exposure to different asset classes, things like equities, bonds, or cash, based on the economic conditions or market trends, or sometimes buy and sell risk type of signals and indicators. The goal is not to just capture upside, but to actively manage the downside risk. It's much more dynamic. Instead of riding stock market crash all the way down, you basically try to step aside and preserve capital and live to invest another day. It's almost common sense in our view. And it's the difference between standing in the rain because weather is just temporary and actually bringing in an umbrella. So buy and hold asks you to endure everything the market throws at you, no matter how brutal. Tactical investing, like what we do, says, hey, maybe we don't need to endure quite so much.
Yeah. And this ability to step aside or at least partially de risk can actually significantly improve long term outcomes. Avoiding large losses is crucial because a lot of people don't understand the math. Recovering from a 50% drop actually requires a 100% gain just to get back to where you started. That's not investing. That's actually, for many people, climbing out of a financial crater. And it's also not just about returns. It's about helping you not lose your mind. And let's be honest, most people say they can handle that kind of drop. Oh, I'll just stay invested. And they'll say that confidently right up until the portfolio starts losing much more than 10%, 20%, they're usually in full panic mode. And it's our experience that, especially retirees, they can stomach some losses, usually up to about 10%, 15% in their portfolio. But then they really start getting nervous when it gets above that.
No doubt. And so, question is now, is tactical investing perfect? Of course not. There is no perfect strategy. It requires skill. You got to know what you're doing. It requires timing. You got to have a solid process. And if you get it wrong, which sometimes it happens, you zig and the market zags, you might miss out on some portions of maybe some market rallies while you're being conservative and maybe you're sitting on the sidelines or in cash. But despite these drawbacks, the case for tactical investing becomes especially strong when considering investor behavior and really real world in the real world outcomes. Many investors struggle to remain invested during the severe downturns, often selling at or near market bottoms. It's kind of like how Mike Tyson used to say everyone's got a plan of attack until they get punched in the face. A tactical approach that actively seeks to limit losses can help investors reduce the likelihood of those costly emotional decisions that come with the fear and greed emotions. So I always say it can help protect you, the investor, from yourself.
And in a world where we see markets that change rapidly and unpredictably, the ability to manage risk proactively rather than absorb it offers a powerful advantage because sometimes the smartest move isn't holding on tighter, it's knowing when to step aside. And for investors concerned not just with returns, but also preserving capital during periods of stress, a tactical strategy presents a compelling alternative to this traditional buy and hold approach. And honestly, if avoiding a financial free fall while everyone else is screaming counts as market timing, then that's not such a bad idea. I'll take it.
Not at all. We joke about we should get some T-shirts on them that say market timer on them. All right. By the way, regarding how we invest, we use something called Advance and Protect. We actively monitor our investment positions. We go in and out of the market at times. There are times we can be literally 100% out of the market. So if our philosophy resonates with you and you want to have your money managed like that, please give us a call. You can reach our office at 847-780-2980 or go online at bnwealth.com. All right, don't go anywhere because as soon as we come back, fiduciary versus non-fiduciary advisor. You don't want to miss it.
Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have with me my favorite and only co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management. We're an independent, comprehensive financial planning firm. We're located in Barrington and serve the greater Chicagoland area. So, Ben, what are we going to talk about?
Such a good segment. We're going to talk about something that's become a buzzword over the last few years, fiduciary. You've probably heard of it. But I know there's a lot of confusion out there. What is a fiduciary? What's the difference between a fiduciary and a non-fiduciary? What's a financial advisor? What's the difference between a financial advisor and maybe an RIA or a wealth manager? Well, guess what? We're going to help clarify that for you today. So if you've been looking for financial help, you've probably come across the terms fiduciary, financial advisor in your hunt. And a fiduciary is someone who puts their clients' interests first, ahead of their own. And a financial advisor is someone who provides financial services that run the gamut from budgeting and planning to managing investments. Now, some financial advisors are fiduciaries, but not all are. And so it can be very confusing.
Yeah. And the first thing we'll just bring up is what is a fiduciary? Understanding that. And what does a fiduciary do? So, a fiduciary is a person or organization that, again, acts on behalf of another person, but they need to put their clients' interests ahead of their own with a duty to preserve good faith and trust. So, being a fiduciary actually requires being bound both legally and ethically to act in the other's best interest.
No doubt. You're held to a much higher legal standard.
Correct.
So what is a financial advisor and what does a financial advisor do? Let's start with that. So a financial advisor is a broad title that applies to several occupations that provide financial advising, either by offering help with retirement, investments and budgeting, or maybe managing finances, including taxes, estate planning, debt management, and more. Financial advisors create and implement strategies to manage and balance portfolios.
Yeah. And let's drill down now from financial advisor. That's a broad term. Now let's get to what we call investment advisors. And the difference here, this is actually a highly regulated term under the Investment Advisor Act of 1940. And I'm going to quote from that where all investment advisors must register either with the SEC and or by state registration and are bound by law to act as fiduciaries, whether in conjunction with discretionary authority or not. So with a focus on investing, investment advisors don't typically mix in financial or tax planning. Their focus is really on investment performance and usually just on the one account they're managing. It's not often a holistic approach.
And then there's also professional designations that can come into play that add another layer on top of this. Now, there are two very common designations, financial planning designations in our industry. One of them is the Certified Financial Planner, CFP, or the other one is the Chartered Financial Consultant, ChFC designation. Those are the two popular ones. And both CFPs and ChFCs are obligated to act as fiduciaries when they give advice or provide financial planning. Some even have a CFA. That's what Matt has, Chartered Financial Analyst. That's the more advanced investment type of designation. They also must demonstrate competency in a range of other financial planning areas, such as retirement, insurance, estate planning, investments, employee benefits, and taxes. These higher advanced designations have similar education requirements, like, for instance, the CFP and the ChFC, similar courses, rigorous training, and experience requirements, and are held to high ethical standards. They're also required to have ongoing continuing education to maintain the certifications.
Yeah, and like Ben said, I have the CFA designation. Ben has the Chartered Financial Consultant designation, the ChFC. So we have these professional designations. But an important point as a consumer to understand, for example, the CFP or the ChFC professional, if they're out there describing themselves as a fiduciary, is describing a professional standard of fiduciary care and not a legal standard of fiduciary care. On the other hand, if you're a registered investment advisor, RIAs, like us, and you're registered with the SEC, the Securities and Exchange Commission, or a state's security agency, that's different. You're legally bound to the fiduciary role if you're registered as an RIA.
So, speaking of that, in our view, the best is to have an advisor who has a professional designation and is also an RIA, a registered investment advisor. So there's both a professional and legal fiduciary standard, again, like us. Now, we're going to add another layer to that, which are wealth advisors. So, who are wealth advisors? This can be maybe an ambiguous title, but it's supposed to mean someone that is focused on more comprehensive planning that looks at the entirety of a client's wealth picture, as opposed to just their investment portfolio. So, wealth advisors may counsel you on issues like taxes, insurance, estate planning. They usually assist clients with every area of their financial life. We are wealth managers, by the way.
That's correct. And so there's in this industry, what we have are different standards. There's something called the fiduciary standard and a suitability standard. So there's a difference. Again, a fiduciary must put their client's best interest above their own interest, above their employer's interest. Basically, the client must come first. And a financial advisor, if they're out there, as we said earlier, they may or may not be a fiduciary. So financial advisors in the US generally operate under one of these two regulatory standards, the fiduciary standard or the suitability standard. The key difference lies in the level of responsibility that the advisor owes to the client. A fiduciary is legally and ethically required to act in the client's best interest at all times. This includes providing full transparency about fees, avoiding conflicts of interest when possible, and of course, prioritizing the client's financial well-being over the advisor's compensation.
In contrast, advisors operating under the suitability standard, so they're not fiduciaries, that standard just requires that you must recommend investments that are only suitable based on a client's financial situation, risk tolerance, and goals, but not necessarily absolute best or the lowest cost option. So brokers often follow this standard, meaning they can recommend products that generate maybe higher commissions as long as they basically meet the suitability criteria for the clients. So let me give you an example. Imagine a client choosing between two mutual funds with similar performances. A fiduciary advisor would likely recommend the lower cost fund to maximize the client's return. A suitability based advisor, however, could maybe recommend a higher fee mutual fund that maybe pays them a bigger commission as long as it still fits the client's profile.
Let me give you another non-financial example. Let's say you went to a doctor for a condition and he prescribed some medication for you that would help with your condition. But maybe it has a bunch of side effects, these negative side effects. But you tolerate them because it's helping your ailment or your ailment. But then imagine you heard from someone about a different medication and it's out there and it will also help fix your ailment with little to no side effects. Well, wouldn't you rather have the other ailment? So you go back to your doctor and you say, "Hey, what about this other better medication I heard about?" And he says, "Oh, yeah, well, I could get that for you too." And you'd most likely say, "Hey, how come you didn't recommend this other medication in the first place?" You probably know why, Ben.
No doubt. That's a classic definition of example. So that's literally the difference between the fiduciary standard of the best thing for the client versus just the suitability standard of as long as it works. And by the way, in my example just now, or your example, Matt, maybe the doctor was, why could the doctor maybe recommend that other medication? Well, maybe he was getting a kickback from the pharmaceutical company that makes that, or a bonus from a sales program that the rep from the pharmaceutical company was holding. That's what influenced his decision on what to recommend, maybe. It certainly could. Did you know that it could be possible in the investment industry as well? That type of scenario. There are investment product representatives called wholesalers who often help provide incentives to financial advisors for selling their products.
Now, of course, they say that it should never sway an advisor's decision, and the money is meant for marketing reimbursements and it's not a quid pro quo. But can you see how it could be a conflict? How it definitely could influence the advisor's decision? And at BN Wealth, we are proud to say we have never taken any bonus or kickback or marketing support or whatever pretty little package name you want to call it from any sponsor. We don't want anything to do with that. We have no one's interest to satisfy besides our clients, and we never want even to risk the optics of that.
By the way, if you have a financial advisor, ask them if they ever get marketing support from any product wholesalers. I'd be very curious to see if they say no. And as with any financial planning, investing, or tax or estate planning strategy, of course, it's essential to work with qualified professionals who truly do understand these concepts and can custom tailor them to your situation. Fiduciaries like us who have your best interest at heart. And usually a good financial planner like us, we are the quarterback of your plan. And we help coordinate it with your professionals, like your CPA or your attorney, for instance.
All right. Well, if you want to explore becoming a client and learn more, reach out to us online at bnwealth.com or call our office at 847-780-2980. We're out of time and we'll see you next week.
God bless everyone.